Welcome to The Explainer. So today, we are tackling something that, let's be honest, can look pretty intimidating at first glance. The income statement. But look, my promise to you is that we're going to take what usually feels like just a chaotic wall of numbers and we're going to flip it into a really clear, logical story about how money actually moves through a business.
To keep things simple, here's our roadmap for this explainer. 1. The core concept. 2. Breaking down the components. 3. A case study on XYZ manufacturing. And 4. The real-world value.
All right, let's jump right into section 1, the core concept. To really get what this document is doing, you have to think about it in terms of a flow versus a snapshot. If you look at a balance sheet, it's literally just a snapshot. It freezes the business at one specific second in time. The income statement, completely different beast. It's dynamic. It tracks the actual flow of your financial activity over a period of time, showing exactly how cash is moving in and out. It's not a photograph. It's more like a movie of your finances.
And the whole plot of this financial movie? It's driven by one beautifully simple formula. Net income equals revenue minus expenses. That's it. That's the foundation of this whole report. Before we get totally lost in the weeds of corporate finance, just remember its main job is to answer one fundamental question. At the end of the day, is the company making a profit or is it taking a loss?
Moving right along to section 2, breaking down the components.
Okay, so everything starts at the starting line, right? And in business, that's revenue. This is the total cash earned before absolutely any deductions. You'll hear it called sales or turnover, but it basically splits into two buckets. You've got operating revenue, that's the money from your main hustle, what you actually do. Then you've got non-operating revenue, which is the extra stuff like, interest from the bank or maybe dividend payouts.
All right, so we have our revenue. What next? Well, we hit our first big deduction, the cost of goods sold, or COGS. These are the direct, totally unavoidable costs of actually making your product. If you're building furniture, this is the wood and the wages for the carpenters. Take your revenue, subtract those direct costs, and boom, you're left with your gross profit.
But as we all know, the expenses don't magically stop at the factory doors. Next up, we gotta subtract operating expenses. These are the everyday costs to keep the business breathing that aren't tied to a specific physical product. We're talking office rent, administrative salaries, utilities, that new marketing campaign. And then we hit one last hurdle, other income and expenses. These are the non-operational hits, mainly taxes and loan interest. The government and the bank, the two partners who always make sure they get their cut. Subtract all that and you finally land at your net income, the bottom line. Positive means profit, negative means a loss.
Let's see this in action in section 3, case study, XYZ manufacturing.
Let's set the scene here. So 2024, XYZ Manufacturing has a killer year in sales. They pull in a massive top-line revenue of $750,000. Honestly, seeing $750,000 roll through the door, that's a huge milestone for any business.
But watch how fast that huge number shrinks. To actually make all those products, XYZ had to buy raw materials. They had to pay the line workers. Their cost of goods sold hits $400,000. So suddenly, that top-line revenue takes a pretty massive hit.
Subtracting that $400K leaves XYZ with a gross profit of $350,000. Still a really healthy number. But, as we just learned, the story is far from over.
Because the reality of actually running the business is going to take another bite out of those funds. XYZ has to pay office rent, salaries for the admin team, marketing. Those operating expenses tally up to $225,000.
So we subtract that out. Now our operating profit, or EBIT, earnings before interest and taxes, is down to $125,000. Operationally, they're doing great. But we still have those outstanding partners who need their cut before we can actually call this cash our own.
Yep, here come the final hurdles. XYZ has to hand over $20,000 to the bank for loan interest and another $30,000 to the government for taxes.
And this perfectly illustrates that whole waterfall effect of an income statement. We start at the very top with an exciting $750,000. Then we wash down through the raw materials, the rent, the marketing, the interest, the taxes, and at the absolute bottom, XYZ wraps up 2024 with a real net income of $75,000. It's just a perfectly logical flow.
And finally, section 4, real-world value.
So here's the thing. This single document, literally one sheet of paper, serves completely different, vital purposes depending on who's actually holding it.
If you're an investor, you're scanning this to spot long-term profitability trends before you risk your money. If you're a lender at a bank, you're checking financial stability to see if these guys even qualify for a loan. Managers, they're using these numbers to figure out where to cut costs or tweak pricing. And the government? Well, they just want to calculate tax liabilities. It's one statement providing a bunch of totally different real-world values.
We just saw how $750,000 at the top can cascade all the way down to just 75 grand at the bottom. Kind of wild, right? And it leaves you with a pretty vital question about your own financial flow. If your business pulled in $750,000 tomorrow, after the materials, the overhead, the bank, and the tax man, what would your bottom line actually be? Honestly, tracking that flow is where the real power of the income statement lies. Thanks for joining me for this explainer.